Welcome to Realcast, the weekly roundup of the real asset markets. I'm joined by Paul Strome, Nicole Dines and Dan Innes. Paul, let's start with you. We had interest rate rises in the US last week and, of course, in the UK as well this week. What was your take there?
Yeah, well, the Bank of England's announcement of a 0.5 percentage point bank rate rise to 1.75 is its largest interest rate hike since 1995, and it coincided with news of a decline in construction output for the first time since January 2021. So the bank also forecasts that the UK will enter recession in the fourth quarter of this year, not next year, as it had previously said. Inflation is now expected to rise from 9.4% in June to over 13% in the fourth quarter of the year, and is expected to remain high throughout 2023 and not falling to the 2% target for 2 years. Neither rate rise nor technical recession were unexpected calls, and it will be a while before the property markets are worried as indexation makes property more inflation-proof. But as one fund manager said, the difficulty for markets is that this is not a traditional UK-only inflation cycle. It's influenced substantially by external factors, which markets struggle to interpret and correctly price, although he said that much of the bad news is already priced in. The news was not universally negative. In the S&P Global CIPS UK Construction PMI, there was an increase in commercial construction work, but this was at its weakest level for 18 months and more than offset by the lower volumes of residential work and civil engineering activity, the survey report said. On a brighter note, the post-COVID return to work has continued apace. Paris, Madrid and Cologne are leading Europe's return to the office, according to research from Savills, which said that the average office occupancy across the continent in June was 43%, which is the highest level since February 2020. Savills said that European office occupancy rates continue to stabilise and that each new variant of the virus is having a more limited impact on office occupancy rates, and the speed of return to the office is accelerating following each lockdown. One problem that they highlighted, though, is that inflation and supply chain issues have pushed up the cost of fitting out office space by an average of 6% over the past year. And elsewhere, of course, logistic markets are still vibrant, notably in Poland at the moment, and not just around the capital. Panettone has sold 2 logistics assets in Lublin and Silesia West regions of Poland to a North American private equity investor. Panettone's CEO for Europe, Robert Dobrici, said that the sale demonstrates the continuing strong investor appetite for modern logistic properties with high sustainability credentials. Macquarie also announced it's acquiring a last-mile logistics asset near Warsaw Airport in Poland from a consortium of investors led by property company 7R. Macquarie is paying about 29 million euros. And in the office markets, Union Investment has acquired 27,000 square metre office building Eclipse in Dusseldorf from the Oman Investment Authority and its joint venture partner, Day Developer. The building's 90% let with PwC as the main tenant, and it's due to be completed in October. That price has not been disclosed, but German media put it at 200 million euros.
Interesting that there's still quite a lot of activity in the market at the moment. Dan, what have you been following?
If you haven't already decamped to the Greek islands or to Italy, or maybe you're watching this from your sun lounger, regeneration has been quite a strong theme. We're watching things like the Commonwealth Games on the television, which is obviously coming out of Birmingham. It's also the 10th anniversary of the London 2012 Games, which of course had such an enormous impact on real estate, logistics and infrastructure across London back then. I mean, it's a quite remarkable time. And of course, it was the ultimate alliance for Europe's largest real estate development at the time, Westfield Stratford City next door. And Len Bingley, who's the new editor at Property Week, he used that as his leader. But he talks about that regeneration legacy on things like Westfield Stratford City, which had the biggest Section 106 agreement ever signed at the time. Other build-to-rent projects are springing up still today around the Olympic Park. People like Get Living and Lend-Lease have been developing all of those sites in and around the Olympic Park. It's only 6 months to go until PSP Investments, Quadrille Property Group and Unibail-Rodamco Westfield opened their Coppermaker Square build-to-rent development next to the Queen Elizabeth Olympic Park. And that's going to be another over 1,000 build-to-rent units. So yeah, still a good legacy that's still building. So regeneration, a big theme this week. Elsewhere, Roundhill Capital, they've now closed that 200 million euro smart studio acquisition. That's the largest PBSA investment. That's houses built specifically by private developers for students to live in. Meanwhile, also up in Scandinavia, a big win for Norway and Oslo. Promenade and Management, which is the prime retail leasing management and commercial firm in central Oslo. This is owned by Mark, formerly Mayor Bergman. They've managed to sign a deal and open a store with Dior, which will be their first ever Scandinavian store. Typically, of course, major luxury fashion houses go to either Stockholm or to Copenhagen, but they've moved immediately to Oslo, in this case, for a new 2-level store on Nedre Slottsgate. So they join other brands like Bottega Veneta, Hermes and Gucci and LVMH. So yeah, I mean, that's an incredible coup for the Promenade and fashion district. Elsewhere, other people have been talking about that Cushman Burbage Realty Partners takeover. That's going to boost Cushman's investment, leasing and development expertise. Burbage, of course, is one of the first specialist industrial and logistics property consultants in the UK, advising on strategic land, occupational agency, investment, lease advisory, that type of thing. So interesting time to see some of the mergers and acquisitions across the market.
You mentioned there the resi stories. I saw as well that Redevco were gearing up for more resi projects, particularly in the UK, by hiring former Elandai investment director Jonathan Cole as UK transaction manager. So some activity there as well from Redevco on that resi space. Nicole, what have you been tracking?
Well, sticking to the UK property register that we talked about before has actually kicked in from Monday, the 1st of August. It's called the Register of Overseas Entities, and we require foreign companies holding UK property to identify their true owners in an official register. Obviously, this is meant to be a crackdown on Russian oligarchs and other sort of dirty money that has laundered an estimated £100 billion in UK real estate over the last few years. So they have 6 months to declare their true owners, but critics say that this legislation is full of loopholes because it targets only companies, and they say that it will be exploited by individuals. So critics say that it should target individuals rather than companies if they really want to make a difference. But still, it's definitely a step forward. And again, something that is involves the UK, but also other states. We've often talked about the importance of healthcare and how companies are getting interested in this sort of fast-growing sector. And one example this week was the Mediclinic International. It's a huge private hospital group that was created in South Africa, but it has hospitals all over the place in the Middle East, in Europe, and in the UK as well. It owns Aspire Healthcare, and they've been taken over for $4.5 billion, 3.7 billion pounds in cash from a consortium, 50% Remgro, which is a South African company owned by the Rupert family, but the rest, 50%, is being put in by MSC, which is one of the largest shipping groups in the world, absolutely massive shipping group. That's what it's always done. And it's now decided to diversify into healthcare, which I think is a very interesting sign of possible things to come. Other companies, in different sectors, looking at this particular sector in real estate, which is fast growing and has very strong potential. Going back to what Paul was saying earlier about the office sector picking up again, there was a report from JLL this week saying that the office sector has taken the lion's share of investments in Italy in H1 this year. Investment in offices had reached 2.5 billion euros in the first 6 months of the year, which is 186% growth compared to the same period last year. In fact, office transactions represent 40% of total real estate transactions this year. Milan, it would be no surprise to hear, is the favorite destination for investors, attracting 1.3 billion and accounting for 24 deals, 54% of the total. And Rome is a sort of distant second with just 740 million. But interestingly, the experts at JLL say that these figures are, will increase. They expect these numbers to go up in H2 this year. And another interesting aspect they underlined, which again we've talked about many times before, is everyone is really interested in ESG compliant offices. So that's an absolute must. So offices that are ESG compliant are very much in demand and are driving the market.
Interesting as well to see in the news, Azora buying into the Greek hotel market with a 5-star hotel buy in Rhodes. That's a couple of stories that we've had on Greece in the last couple of weeks. So interesting to see that. Thank you, Dan. Thank you, Nicole. Thank you, Paul. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the real asset markets.